Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to tackle the question, how do you work out whether you should sell and replace an investment property? So that is, if you have a property and you suspect that property might not be investment grade, or if you think about, if you had your time again, you wouldn't buy that particular property, how do you know if it's worthwhile to actually replace that asset? And it's a really important decision because I guess the last thing we ever want is to sell an asset today for, say, $500,000, and then we, see online that the property's sold again for $1 million in 10 years' time. We just kick ourselves if that happened, of course. And because property prices tend to just generally trend higher over time, the chances are that at least there's a risk that we could be worse off if we go and sell an asset. But it is a very important decision because, if we think back in 20 years from now and we compare our assets' performance, and if it hasn't performed so well, even a relatively small variation in capital growth rate over, many decade periods can make a huge difference in dollar terms. And remember, it's dollars. We pay for our retirement in dollars, not in percentages. So if I could sell an asset today and I'm confident I'm going to be, two, three, $400,000 better off in 20 years' time in today's dollars on an after-tax basis, then I would be silly not to pursue that because that's 2, 3, 4 years worth of living expenses in retirement. But of course, divesting of an asset is not a costless or riskless exercise. So firstly, there's an asset selection risk. I go and sell an asset because I don't think an existing property, because I don't think it's a great asset. But then it's on me to make sure I buy a replacement asset and that replacement asset performs better than the existing asset. Now, that might not happen. It could be just due to general market conditions, something unforeseen, such as COVID or higher interest rates or those sorts of surprises. Or maybe I make an asset selection mistake. Now, hopefully that's not the case, particularly if you're listening to this podcast and you get some good quality advice. But it's not a riskless exercise. Of course, selecting a replacement asset still carries some risk. The next thing is there's a whole bunch of costs that will need to be paid to replace a property asset. Firstly, there's selling costs. You need to sell the existing asset. And that's not just agent fees. That could be the fact that you might need to make some cosmetic improvements to that property to make sure it's well presented. Probably have to get the tenant out of that property. So it's going to be vacant for a period of time. And of course, you might need to stage the property also. So I don't think we can underestimate the cost to sell an asset. Often people think about agent fees, but there can be a few more costs in addition to agent fees. And then, of course, when you rebuy an asset, replace that asset with an investment grade asset, you're going to have to pay for stamp duty, buyer's agent fees. Hopefully, I'd recommend using a buyer's agent. Of course, you don't want to make another mistake. And legal fees, and there could be other expenses such as building and pest inspections and those sorts of things. So there's that element of cost. And then lastly, capital gains tax. And, capital gains tax can probably never be avoided. Well, it can if you never sell the property, but someone's probably going to sell it one day. So someone's going to pay it. So it can never really be avoided, only delayed. And sometimes people are very reluctant to replace an asset because it has a large amount of capital gains tax consequences. And of course, people loath to, end up paying a very large tax bill in any particular financial year. So that's reasonable. It's reasonable, I think, to want to avoid, or I should say delay, paying tax for as long as possible. But of course, there's an opportunity cost associated with that. And I'm going to delve into that. So how do you weigh up, or how do you take account of an asset that's going to crystallize a really large, substantial tax bill versus one that, maybe there's no tax bill at all? Of course, in those two situations, you want to account for the opportunity cost of having to pay that tax sooner. So as you can see, the decision is quite complex in that it gives rise to a lot of potential financial consequences in terms of costs and risks and those sorts of things. And that's why it's a decision that is a really important one. So what I'm going to do is take you through the process that we employ in our business to sort of work through these numbers. And hopefully, every person's situation is a little bit different. So it's hard to find a process or a very sort of checklist orientated way of this is all the things that you need to think about, because as I said, everyone's situation is different, but hopefully it gives you a sort of general theme on how to navigate this sort of important decision. And the first thing is to set realistic expectations and have a realistic benchmark of what returns you should expect over the long run from a particular asset. And firstly, the quality, even if it's investment grade, the quality of that investment grade and the type of that asset will have an impact on its returns. So, for example, an entry level one bedroom investment grade apartment, you can't expect it to deliver the same returns than an investment grade house, for instance, because of course the house is probably going to generate sort of higher returns. And we need to be careful, or we need to, include that fact in our benchmarking to make sure we're not being unrealistic, or we don't have unrealistic expectations of our assets. Now, historically, both from a income and growth perspective, in Melbourne and Sydney, houses have returned on average since 1980, so the last 45 odd years, 9.7%. Now, that's the median house price, of course. Now, we hope by using a set of asset selection principles, evidence-based approach, and so forth, we should certainly be able to outperform the median. And the median is just really the midpoint of all those sales. So, more than 50% of properties did better than the median, and 50% of properties did worse, of course. And so hopefully we want to be in that top 50%, by using those asset selection principles. But just to be really conservative, I think a long-term return of like 9%, I think is really realistic. That is that if I'm going to develop an investment strategy, I hope I'm going to beat that goal. I'm going to aim to beat that goal, but I just want to make sure my investment strategy works if I earn 9% per annum. That also accounts for market cycles, and sometimes market cycles are unpredictable. They're easy to spot, in hindsight, but they're sometimes difficult to kind of predict. And also for the potential risk that on a percentage basis, property growth slows down. So when property was, $80,000 in the early 80s and it rose 10%, it rose by $8,000. But an $8,000 increase on a property value today is nothing. And so I think realistically, we need to assume that percentage return, particularly if we're measuring it over the 80s and 90s, is going to slow down at some point. So I think 9%'s a realistic expectation for property that's in a main capital city, particularly Melbourne and Sydney specifically, I guess. And that 9% will be a combination of both growth and yield as well. Now, if the property is located in a, say, small regional town, where there's a oversupply of vacant land and very low demand for housing in that location, of course, you're not going to get 8% over the long run. And it would be unrealistic to expect so. And this is where I think some people can get sort of tripped up when thinking about property and choosing property. We really need to be thinking, what will this property generate over the next 20 and 30 years? Because what we're looking for is the highest average return over that period of time. And then we look at the fundamentals of what's going to drive that return, and why would that return be higher than, say, a blue chip, well-established suburb in Melbourne and Sydney. Then I think it helps us to be a little bit more realistic about our benchmarks. Of course, the location also affects the components of return. If we accept that obviously supply and demand fundamentals are different in regional locations than they are in capital cities, then those longer term returns might range from, say, 6 to 7.5% rather than 9%. And I think it's unrealistic to expect a location that doesn't have the same supply and demand fundamentals to return higher average returns over very long periods of time. So therefore, if you're investing in a house in a regional location and you're enjoying say a 4% rental yield, then you can probably only expect 2 to 3%, 2 to 3.5% of capital growth. And expecting a higher growth over the long run might be unreasonable, because what you're doing is you're assuming the total return is too high. So let's say if I think I'm going to go and invest in this regional location, I'm going to get a 4% rental yield, and then I'm also going to get 5% in capital growth. So a 9% total return from that particular asset. I would say, hang on, why would that location return 9% when I think the reasonable conservative estimate is, say, 9% for Melbourne and Sydney in terms of very well established, very large capital city markets that deliver tremendous employment opportunities. So all this is really leading into setting some realistic benchmarks to compare against, because obviously we need to work out, we've got a particular asset. Should we sell that asset? And then if I invest in a different asset, I need to know what returns I'm likely to achieve from that different asset. Now, back in March 23, I published an episode that sort of discussed the 3 attributes that a property must possess to be considered investment grade. The first one was a persistence imbalance of demand and supply. So we want that property to be located where there's no further supply of vacant land and there's not in close proximity, and that demand for that location always exceeds supply. So you've got that imbalance of supply and demand. 2, you've got strong historical growth. So again, for using a rules-based, evidence-based approach, we want to invest in a location that has demonstrated it's got the capacity to deliver good returns over multi-decade periods of time. And 3rd, that large proportion of the property's value is in the underlying land rather than the improvements on that property. Now, due to these attributes, investment grade properties tend to deliver less income and more growth. And that's actually what we really want, because what we want to do is benefit from compounding capital growth over many decades. And that's going to do the heavy lifting. As I said, if you get 7.2% in growth over time, your property is going to double in value every 10 years on average. And so, if you buy $1 million property today, in 10 years it's worth 2, in 20 years it's worth 4, in 30 years it's worth 8. That's $7 million of capital growth over the next 30 years. 30 years is a long time, I get it. But, that's done a lot of heavy lifting, and that's really the power of compounding capital growth. So if we assume that we're going to target a 9% total return, then I think it's reasonable to expect an investment grade asset to maybe provide 2% income and 7% growth. And I think they're realistic benchmarks. Now, remember, we're talking about median house prices, median returns here. So again, what we're trying to do is beat the median, but in terms of making sure we've got some realistic but conservative benchmarks, they're the realistic and conservative benchmarks that we should compare against. So therefore, if I've got an asset and I'm not really sure whether this asset's investment grade, what I want to do is say, well, if I sold that asset and bought an asset that's going to give me 2% income and 7% growth, will I be better off? How soon will I be better off, and should I do that? Now, of course, to make that comparison, I need to form a view on what future returns that asset might deliver. And so there's no perfect scientific way of doing this. It really is quite subjective, and we need to be conservative, I think, but also at the same time realistic. Now, typically rental yields don't tend to change very much in a particular location. So when you have a look at the rental yield over the last 20 years, that'll give you a good sense of, what income you can probably expect. Rental yields can change sometimes if the location is undervalued. So if the location is undervalued, maybe current rental yields can be somewhat overstated, but you should be able to see that in the data. And when you go back and have a look at, what is the average rental yield for Melbourne for houses, for example, you'll get a good sense of, what that number looks like. And I think you can probably, in most situations, assume the rental yield is going to continue broadly in line with what it's been in the past. So if you've got a property, it's a house, and you're enjoying a 3.5% rental yield, I think it's reasonable then to probably expect, unless there's information that suggests otherwise, you can probably expect that you're going to get 3.5% in the future. So the difference then is going to be the growth. And that's what you really then need to form a view on. If I'm going to get 3.5% income, how much growth will I get? Now, one word of warning is to be very careful about relying on shorter term returns when setting growth expectations in particular. And as I mentioned in this podcast many times, property moves through two cycles. A flat cycle is followed by a growth cycle, and that growth cycle is followed by another flat cycle, and so on and so forth. So if you own a property that's just been through a growth cycle, it would be erroneous to extrapolate that more recent growth, say over the last 5 or 7 years, and think that's going to be sustainable over the long run. In the long run, there will be some sort of mean reversion. And so you need to sort of factor that into your benchmarking. And really, it's about looking at really multi-decade periods of growth in order to form a realistic expectation of what the future capital growth from that asset might be. And remember, just be really careful to make sure that you're not going to expect an asset that is in an inferior location compared to, a blue chip suburb in Melbourne and Sydney, then it's going to return a higher overall return than those assets. So for example, if I got a 3.5% yield and I thought, well, I'm going to get 7% growth, that means a 10.5% total return. Well, when we look over 45 years at a median level in Melbourne and Sydney, that hasn't done that. And so then you've got that's a good sort of sanity check if you're being too bullish in terms of your expectations. And so once you've done that, you've got something to compare it to. You can make a decision and say, okay, I think my property is going to return X. I'm going to now compare that to owning a property that gives me 2% income and 7% growth, and then work out over different periods of time how much better off I will be. And I've included those tables in the blog on the website. So difficult to go through that here on the podcast. But so what I would encourage you to do, and the link is in the show notes, is go and have a look at those tables. And essentially what I've done is I've prepared a table assuming 8% total return and a table assuming a 7% total return. And if you think your total return is going to be less than 7%, you can kind of extrapolate the sort of theme of the outputs and so forth from what you've got there. Now, the reason I've chosen 7 and 8% because I've determined that 9% is a reasonable but conservative overall return expectation for property over a very long run. And so we're only going to do this exercise for a property that we think is, not going to achieve that benchmark. And so that's why I've looked at 8 and 7%. Now, if your property overall return is less than 7%, chances are you are going to be better off divesting of that property, again, unless there's something substantial or unique about that property that would suggest this approach isn't appropriate. So to give you an example then, and these numbers are based on $1 million property, right? So if your actual property is worth 700,000, then you should take 70% of these numbers. If your property is worth 2 million, then you should double these numbers. So that's how to use the tables in the blog on the website. And I've got the full explanation there anyway. So what I've done is calculated how much better off you would be if you sold the asset that you have, repurchased an investment grade asset, and net of cash flow, capital gains tax, income tax, negative gearing benefits, all those sorts of things on a complete after-tax basis. So after you go and sell the asset, how much would you be better off after 10 years, 20 years, and 30 years? And it's going to give you then a number to sort of anchor to contextualize, what is the difference in returns. So for example, if I had a property and I expected 4% income and 4% growth, so 8% total return, then selling that property and buying an investment grade asset, after 10 years, I'd be $200,000 better off in today's dollars after tax. In 20 years, I would be $620,000 better off after tax in today's dollars, of course. And in 30 years, $1.4 million better off in today's dollars, again, after tax. Now, that's just the gross benefit. We need to reduce that gross benefit by some of the transactional costs, not capital gains tax though, some of the transactional costs and the opportunity cost associated with paying these costs today versus paying tax in 20 years' time when we're retired. And so that's really the step, is work out how much you're better off, less transactional costs, less opportunity cost, and the net is what you will be net better off. And I'll take you through that now. Now, I say reduce the amount by transactional cost, but not capital gains tax. And the reason I say that is because we need to compare these assets on an after-tax basis. And the reason for that is what we're doing is we're investing to fund retirement, and we're assuming we're going to need to sell that asset one day to fund retirement, to benefit from the equity that I've accumulated in property. And so the best way to do that is to compare those two assets on an after-tax basis, which is what I've done in those tables that I just spoke about. But what I haven't included in those tables are selling costs and buying costs, such as stamp duty, agent fees, these sorts of things. They're going to be different in every situation, and they're going to depend on the property type and its situation, all those sorts of things. So they're quite unique, and you can't make necessarily big generalizations with those. So what you have to do then is determine a reasonable estimate of selling costs. You're going to have to pay for agent fees, which are typically sort of 2.5%, around about that 1.7 to 2.5%, depending on location. You then got to think about vacancy, whether there's any improvements that you need to make to the asset, staging, and those sorts of things. Then buying costs, your big ones are going to be stamp duty and buyer's agent fees. And then there's going to be some other costs like legal fees and those sorts of things. So you need to reduce that benefit that I just calculated by those costs. And then you need to make an allowance for opportunity cost. And the reason we need to make that allowance is because I'm crystallizing these costs today. I'm crystallizing the selling and buying costs, and I'm paying tax today when I don't really need to, because maybe I can avoid paying it for a few years or until I'm retired and so forth. And so there's an opportunity cost associated with those outlays because I'm worse off initially, but I hope to be better off in the future. And so I need to account for that opportunity cost. And so the way that I've done that is I've worked out in today's dollars, if I didn't pay the tax, if I didn't pay the stamp duty and so forth, and I invested that money, I earn a 7% return, 3% income, 3% growth, which is kind of very conservative estimate of what I might get from the share market. On an after-tax basis, how much could have earned on that money over a period of time? And so in the blog on the website, again, I've got another table which tells you what the opportunity cost of the transactional costs will be. And I've, again, done that over 10, 20, and 30 years. So let me take you through a worked example then. And this one's going to be a bit different to the other one. So I've got a property. I think I'm going to earn 3% income and 4% growth, 7% total return. I want to compare that to selling that asset and buying something with 2% income and 7% growth. So something a little bit different than the example that I previously gave you. Well, my first table says that after 10 years, in today's dollars on an after-tax basis, I'll be $240,000 better off if I did that. But I know there's going to be selling costs, so I need to reduce that $240,000 by $25,000 for selling costs. I know that there's going to be rebuying costs, so I'm going to reduce that by $65,000 for allowing for stamp duty and so forth. And then what I need to do is calculate the opportunity cost. And what I've done is I've assumed, okay, I'm going to pay for $90,000 of buying and selling costs, the 25 plus the 65 I just mentioned. Let's assume I'm going to have to pay $110,000 in capital gains tax. And these are just rough numbers, by the way. They're just assumed numbers just to make the point. So I'm going to have to outlay $200,000 today, and there's an opportunity cost associated with that. And so what I've done is looked up at the table and worked out my opportunity cost of outlaying $200,000 today is $124,000 after tax in today's dollars over a 10-year period. So to calculate whether I'm better off, it's the 240 less the 25 selling costs, 25,000 of selling costs, less the 65,000 of buying costs, less the 124,000 of opportunity cost, means I'm net better off by $26,000 over 10 years. The table is on the website for this worked example, but over 20 years net, I'm better off $326,000. And after 30 years, I'm net better off $925,000. These are all in today's dollars. So clearly with that example that I just gave, clearly the longer the time period, obviously, the better off I'll be. It's just really a question of, will I be able to, is it realistic to be looking at that 20 and 30 year time period, which I'll get to in a second. Also, it shows that if I'm selling an asset and there's a lot of capital gains tax to pay, $110,000 in this circumstance, then it becomes more likely that you're not better off to divest of that asset. I'm not saying it's definitely unlikely, but it's more likely. Whereas if you can keep those transactional costs quite low, and remember, if we're selling a dud asset, chances are, unless we've held it for a very long period of time, there's not going to be a lot of capital gains tax. So that's a positive, I guess, but that's how we sort of factor it all in. So once you've done those numbers, then you need to really ask yourself, is it worthwhile me paying that? I mean, I'm not going to go through this exercise just to be better off by, $5,000 in today's dollars. It's kind of barely worth the time and effort to do that. So some of the things that then you need to think about to put some context around that decision and there's a bunch of different questions you need to ask yourself. So can you afford to buy a superior quality replacement asset? And that's going to depend on your cash flow position, your borrowing capacity, all those sorts of things. But, if I'm going to sell an asset, but my budget is quite tight, I'm going to have to make some compromises. Well, then you may be better off just retaining the asset that you've got. Whereas in a different scenario, if I've got, oodles of borrowing capacity today, and this is quite a common situation. So I bought a property 7 years ago. My financial situation is much better today than it was 7 years ago. And if I had my time again, knowing what I know today, I would have spent a lot more money on that asset. So if I've got a lot more capacity to buy a better quality asset today, then, it adds more weight to obviously going through and doing that. The next thing is how sensitive are you to the underperformance? So, this tells us how critical is it that you need to move that asset on. So, for example, if I've got a client and they own an asset and it's not perfect, it's not absolutely terrible, but it's not perfect by any stretch of the imagination, but they're otherwise in a fantastic position. And I know I'm going to sell that asset in maybe 10 years' time anyway to fund retirement, then I might not want to necessarily go through the effort and risk associated with replacing that asset, particularly if I know it's not going to be that critical, that they're going to be okay anyway in the long run. Now, I know that there's an element there of saying, well, yeah, Stuart, but they're not really optimizing their position and squeezing as much future value out of their financial position as it is. And I acknowledge that, but it's just one of many considerations to understand how important it is. Whereas if I know that in a situation a client doesn't have, surplus assets, and that every single little bit, every another $200,000 will actually make a big difference to their outcome and their, how comfortable their retirement is, then it's more important to replace that underperforming asset. Next thing to think about is the time until retirement or potentially selling that asset. So again, if I've got a client with a property and we think it's okay, but it's not great, but hey, anyway, in 5 years' time, we're likely to sell the asset when we're in retirement, then there's no point doing anything with it today. Whereas if I've got a client and they're in their 30s and the asset is questionable, I know I've got a very long runway and they're going to work until they're 60 or beyond. I know I've got a very long runway, a very long time horizon. Chances are we're talking about substantial difference in wealth over that period of time, and I'll be more inclined to sell it. And the other question to ask yourself is, can you buy the replacement asset today? So this is what we do with some clients. So if we've got a property and we go, it's okay, but it's not great. If we've got the capacity, what we'll do is we'll buy the replacement asset today and we'll just monitor the existing asset closely over the next couple of years. That way we can get into the market, and if the existing asset actually turns out to be a bit of a dud, it's cool. We've got this other asset and it's going to be a better asset in the long run, deliver the returns. Also, if we go and buy that asset in a couple of years' time, we actually have more data and we're more convinced the asset is underperforming, then we can sell it at that particular time. But I like that idea of actually buying the replacement asset now and then just waiting to see what the market tells us if there's not enough compelling data to really determine the asset should be sold. So there's some of the things that will give you a bit of context around these figures. Can you afford to replace the asset? How sensitive are you to the underperformance? how much time horizon do you have? You're going to retire in a few years' time, or you're many decades away from retirement, and can you replace the asset now? Now, as I said at the beginning, I've done my best to make this as broad as possible in terms of its application. I think the most important thing here, I mean, the numbers are very important, but the most important thing here is to understand the methodology in terms of working out, we've got a realistic benchmark, forming a realistic return expectation for that asset, working out how much better off we'll be, reducing that amount by the transactional costs, and then taking account of the opportunity cost, and then looking at it over a 10, 20, and 30-year time period, and then considering all those non-financial considerations to sort of working out or giving some context to some of those numbers. Now, everyone's situation is different, however. Everyone has other investment assets, everyone has a different strategy, all those sorts of things. So I wouldn't necessarily encourage you just to follow this verbatim without any discussion from any other advisor or accountant or so forth. But hopefully it does give you a good theme for tackling what is a really important decision and a very common decision, to work out which property to hold, which property to sell if you're less than convinced that you've got investment grade assets. A bit of a longer episode today, unfortunately, so I apologize for that. This one was a bit of a head scratcher, I'll be honest, in terms of walking through this process and trying to articulate and make it as simple as possible, because it is a relatively complex problem. As I said, it's hard to go through tables and a lot of numbers on a podcast, so I'd certainly encourage you to have a look at the blog on the website. And we're probably out of time for any Q&A today, so until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.